Happy New Year, everyone. I'm here to quickly present our first capital markets outlook of 2025. If you've been following, you know once a month we have a capital markets outlook where we continue to look at changes in the environment, changes in the market, reflections of pricing to see if there are opportunities where there might be opportunities. And when we do our capital markets outlook, it's very short. We hope you'll take a chance to take a look at it. It starts with an operative scenario. Our operative scenario currently is that economic growth does continue to improve. We'll see higher sector and name variance, no surprise, because we've seen an aggregated market around the uber large cap securities in the growth environment, or otherwise known as the Magnificent Seven as they become known. We will see a Federal Reserve that if they're not going to cut rates that much further, they at least remain capable of cutting rates further. And that's a very important distinction of a Federal Reserve that can suppress volatility or help the environment if we were to see an economic slowdown by providing stimulus and cutting rates. The important part is they can more than will they and when they at this point in time, because we are no longer at a zero interest rate environment. So that's supportive of the overall environment. We have seen many of the valuations in the environment reflective of a Federal Reserve that is accommodative of a growth in the economy. And we see that in multiples in the S&P 500 stocks that are higher, significantly higher than a long-term average. We need to see economic growth support earnings growth, and we think we will see about 10 to 11% earnings growth this year help support a continued growth in the S&P 500. So we remain at current reasonably positive, but less positive than we were coming into prior months, partly because we've got some catalysts that we think will lead to shorter term volatility in prices, because there's some uncertainty in what policies will be enacted and which sectors they will implement on, and some of the individual names that will be beneficiaries or detractors from policies that are implemented. So we'll start to see more of that in the coming months. And certainly, what I talk about is the first 100 days of this new administration being one of the most important first 100 days in history, because of the landscape change that we're going to see, because of some of the policies they've talked about, things from the so-called DOGE of cutting out government spending to incentivizing more potential M&A by reduced regulation and oversight from the FTC. All of these things will have impacts and create opportunities in the market we see. So our operative scenario is reasonably positive, a little less sanguine than before. We also look at two other scenarios. This is an upside and a downside, partly because we're not always right as market prognosticators, and we want to look and see what changes are happening that might lead to that downside scenario. In the downside scenario, we would see, which would be scenario 3 in our case, we would see continued inflation go higher and a Federal Reserve that actually could even start to hike rates or become certainly less accommodative for a longer term. How does that look? That looks like a Federal Reserve that says their neutral rate is rising. And we as market participants look to the longer term expectation of interest rates to tell us whether the neutral rate is rising, meaning will they keep rates higher for longer? In a higher inflation scenario, they are likely to keep rates higher for longer. Right now, inflation is not spiking up to concerning levels. We do see jobs, employment that is doing extraordinarily well, and oftentimes that is coincident with higher inflation, but we haven't seen that yet. That's certainly a watch point for us of what's going to be happening with consumption and consumer inflation, and will tariffs and trade discussions lead to supply chain issues that in previous years led to a spike in inflation. That's a watch point for us, but it's not something that is materializing right now, and it's not a central expectation for us either. One of the downside would be, should the artificial intelligence, the AI bubble, not materialize for companies to for things like revenue gains and margin expansion potentials, that would be a concern for especially those magnificent stocks, the Magnificent Seven stocks that we discussed that have higher multiples, higher expectation of future earnings growth. That's not what we expect either, but that's a downside scenario. An upside scenario would be certainly where the Federal Reserve is more accommodative, even in the face of a reasonably growing economy. We might see that if we see good employment at the same time that higher inflation doesn't materialize, that we are at a 2% target for the Federal Reserve, and they feel that it's okay to come down to a much lower neutral rate, a much lower long-term rate to control their dual mandate of labor and inflation at the same time that we see economic growth. That could lead to not only earnings growth for companies, but a little bit more multiple expansion. That would be an upside scenario. We don't see the Federal Reserve being overly accommodative in the face of the potential for inflation. So we sit in an operative scenario now. On that lower blue side on the chart that you see on your screen, you'll look at just the big picture points of what I've talked about, which is the Fed is at an easing cycle currently. It's slowing its easing cycle, meaning less expected cuts, but it still can cut. And that's more important than will it cut and when it will cut, is they have the bullets in the gun. They have the ability to incentivize the market if they need to. Earnings in the consumer remain surprisingly resilient. We'd like to see the lower income consumer increase in sentiment and potentially increase in spending. That has been a lackluster portion of the market. We think we'll start to see more of that this year as supportive policies start to help areas of the lower income consumer. The valuations in the market are elevated, but not everywhere. The valuations are certainly elevated on higher market cap technology stocks, certainly the Google and the Apple of the world. Higher cap technology stocks are areas where there are elevated valuations that may still benefit from more implementation of artificial intelligence. What is not super elevated or is much less rich than the technology stocks is areas like mid-cap stocks and value stocks as well. We think that this is a year that we will start to see a broadening of the market, meaning returns and expansion in margins for companies due to some of the technological innovation and some pharmaceutical innovation as well that we've seen over the course starts to take hold. That's our three scenarios that we look at. If we look at the next page, that translates into asset class outlooks. We look at the equity market, the credit market, the rates market. That's things like government bonds and whether rates will go up or down. And then we think about individual sectors and thematics in the environment. On the equity market, we moved this month from positive to neutral. We have been positive as we have seen continued support from especially the technology sector. We're moving to neutral on an equity market outlook as for the nearer term, we'd like to see some of the policies that will make it through Congress that will have impacts on individual sectors, individual names, and the overall market structure before we see continued rise. We think there will be potential for volatility or uncertainty in what the impacts will be that could be negatively weighing on the equity market over the shorter term. That led us to a neutral rating overall. Trend growth is still reasonably positive. We will look for this upcoming earnings season to give us an indication of whether some of the CEOs and CFOs that are opining on the overall corporate outlook are giving an idea that they're going to start translating to more capital expenditure and an expectation of more sales. That's an important metric for us as well. On the credit outlook, we move to negative. Just remember, when we talk about credit, we're not talking about yields. We're talking about the excess compensation that a company pays for borrowing in the market that reflects its default risk. And that has been very low because yields have been elevated. Yields have been elevated, and that has somewhat compressed the excess compensation for default risk that companies pay. That's their spread. We see this as very low. That doesn't mean there aren't opportunities. We do see opportunities in the market, especially with those companies that are coming to the primary market or borrowing in the market with us being an initial lender in the market, and they pay an excess compensation for that. So we're shifting around a little bit of how we might look for where the opportunities lie in the primary market versus the secondary market. Overall, credit is not paying an excess compensation that is extraordinarily rewarding for the default risk in the market. And if we see a financial condition closure, if we start to see lenders like ourselves stop lending as much to the market, that would be concerning for companies and could lead to a higher spread, which would be detrimental for credit. The rates market, we become positive on interest rate duration, meaning we think that there is some attractiveness in being rewarded for yields where they are now. The 10-year yield, as I speak now, is around 4.8%. It may go higher. it may go lower. What's important is that the correlation to the equity market is more supportive now. So it will help buffer volatility if we see the equity market have a sell-off. We think it will be rewarding for investors to be involved in the fixed income market, as we'll see yields come down to reflect lower potential growth, which means prices go up. And that's good for investors. So we've become a little bit more positive on interest rate duration or government bond yields potentially dropping. On thematics and sectors, we have some sectors that we are starting to like. Financial sector is a reasonably attractive sector when yield curves are steepening, when the longer term government bond yield is higher than the shorter term government bond yield. That is beneficial for banks generally, as they are borrowing short and lending long. So they want to borrow at a low level, lend at a higher level, and make a net interest margin on the back of that. That's positive for them. We've seen a rising or a steepening interest rate curve that should help the banks, and so we have been reasonably positive on the banking sector. The energy sector we remain positive on. It still is very cash flow yield positive. We'd like to see that for those companies. And some of the uncertainty that we see in the geopolitical environment, we think will keep oil prices elevated for at least the visible period for this capital markets outlook. Some of the thematics that are out there, obviously artificial intelligence is the most important thematic that we have seen in over a decade. This is something that is driving and has driven these Magnificent Seven stocks to extraordinary valuations, part because they're the first beneficiaries. Those that sell the chips are one of the first beneficiaries. Those that take and deploy the chips for uses of artificial intelligence to create new drugs, to create new visibility on the type of consumer they might want to sell to, or marketing methods, or finding efficiencies in how they manage a warehouse. Those are second order effects that we think we'll start to see this year. That's a broadening of the market. So industrials and energy companies and pharmaceutical companies start to realize more of the benefits of this technological innovation that we have seen. It's a thematic, but it's a broadening thematic, where in prior years I would have said the larger cap companies, like the chip makers that are able to immediately make hay from increased utility of this. Now we're going to see the second order effects, that broadening to a market that you might not expect. These are consumer companies or clothing companies that are able to use them to find efficiencies for themselves. We're looking for those opportunities as a thematic that investors should be exposed to, because that will lead to longer term growth and earnings growth. Overall, that's where we stand on our capital markets outlook for January. We'd be happy to communicate this back to you in February as well, as we'll do this every month of the year and make sure we keep our eyes on the ball. That's what I have for you today. Happy New Year again. Thank you for listening. We look forward to speaking with you soon.